Hey you guys, my name's Jeff. How's it going? Welcome to the channel, and today I'm going to start with a little story time. You know, I have a friend, we talk a lot about investing things, and he said there's one thing that I told him about several years ago and it has stuck with him, and he always thinks about this, and that is this. These companies that sell you mutual funds or ETFs or any kind of financial trading platforms, they are marketing companies. I know they say that they're, ETF providers, or they say that they're mutual fund companies or whatever, but they're marketing machines. And let me just tell you what they do. They make a whole bunch of different products, okay? Now, since you and I are investors, we just look, oh, bright, shiny thing. Look, it's an ETF. I want to get, should I get that ETF or should I get that ETF? Should I get this one? Well, what those are products that they are selling us. And their game is to get as many investors as possible on their platforms and buying their stuff, because they get a percentage of every dollar you invest with them. And here's kind of a dirty little secret about the ETF industry, which is kind of a relatively new industry. It used to be the mutual fund industry. So what they do is companies make a whole bunch of different funds, all right, or a whole bunch of different ETFs. And they let them go for a while, and they see what the returns are and whether investors get excited about them. Some of them do really well, and then a bunch of them do really poorly. So they kill off the losers. They just end, they close down, they return the money to people who invest in the ones that have bad records. And then they keep the ones that have good records, that have a lot of assets flowing into them. And they make a lot of money that way. And of course, they publicize the ones with the great returns and the really great results. But the reason I'm sharing this with you is because I came across a few different ETFs that are offered by this company that I think makes one great ETF that I invest in. The company is called Avantis. And I have no positive or negative about the whole company, but I'm using this example because it's going to teach you something really important, I think, about investing. When you get to the end of this video, you're going to understand something about this game and how you're a player in it by investing in these ETFs. I want you to win more often than lose. I really don't want you guys to lose money unnecessarily. So let me show you what I'm talking about here. AVUS, this is the ETF by the Avantis company, and it's called like the Avantis Equity U.S. ETF. I could get you the, all right, you know what? I'm going to get you the real name. It's right here. I'm going to get that name for you because you deserve it. All right. It is called the Avantis U.S. Equity ETF. I should have just stuck with my first hunch about that. So what this ETF tries to do is buy a representative sample of U.S. stocks. So what do we have in this U.S. equity? Equity is just a fancy name for stock. We have Apple, Microsoft, Amazon, and if you're looking over here, do you see something in common? Here's VOO, that's Vanguard's 500 index. And you've got these all here. Apple, Microsoft, Amazon, Google, Class A, Meta, ExxonMobil, Google, Class C, JP Morgan Chase, Merck, Chevron, okay? This is the package of all the stocks that the ETF provider, AVUS, puts together for you. And then there's another company called the ETF sponsor that actually do the mechanical part of buying and selling, the creation and the redemption that create the ETFs that we trade. Anyway, what this is a basket of stocks, and you pay 0.15%. That's the expense ratio. That goes to Avantis. That goes to their company. That goes to helping them make a profit and pay all their portfolio managers and all their executives and the people that work there. Hey, nothing wrong with that, right? It's the American way. Got to make some money. Now, VOO, that's actually part of Vanguard Group, and they are not driven by the same profit motive because it's a non-profit company. Vanguard is actually owned by the shareholders. So when you buy shares of, say, their ETFs, they don't charge as much because it's not a publicly traded company. They're not trying to make a profit every year. They just run their organization, they pay the people who work there, but Their goal is not to increase their earnings quarter after quarter. Now look here, what's the difference? I spotted it. Do you spot the difference? I'm going to give you a clue. Boom. NVIDIA. These guys got very clever. They have a nice list, but they left NVIDIA off of their US equity ETF, and I think that's a big mistake. Without going way into detail, NVIDIA is driving the future of chips, technology, and graphics processing units. It's going to probably be one of the biggest companies driving artificial intelligence. And they left it off the list. Maybe it's further on down their list, I'm not sure, but I haven't looked at all the holdings in AVUS, so it might be their 11th or the 27th holding, I don't know. But for a company as dominant as NVIDIA, Vanguard got it right. They put it on their list. And so what this leads us to is this. And you're probably wondering, what is this? Well, this is a tube of sorts. It's you can see it, right? So the reason I brought this along, actually I just need this part. You might be wondering why I have this tube here, right? And the reason is that it relates to this, entrar pelo cano. This is a Brazilian Portuguese expression. If we have any Brazilians watching the channel, you'll know what this means. Literally, it means to enter into the tube or to enter into the pipe. But what it means is to be in a really tough situation, to be screwed, to be in a tough spot, a big problem that maybe you created it or maybe some other person or some other force created it. It doesn't matter. You are screwed. You are stuck in that tube. Anyway, what I want to say is that, you know, that ETF provider made a big mistake by leaving NVIDIA out. But you know what? That is just their problem. And what I want to share with you guys is that you don't need to pay a lot of money for companies like Avantis to make a US equity ETF for you. Because really, are they going to make a better ETF than all the other companies that are selling you guys ETFs? I don't think so. It's all about those assets under management. I haven't counted, but I think Avantis, which is a pretty new company, has, you know, at least 5 or 10 different ETFs. And you wonder, are they coming up with a methodology that's better than all the other ETF companies out there? And my guess is at least 1 or 2 of their ETFs might turn out to be real winners, but probably some of them are just duplicating what already exists. So, like I said, it's all about the assets under management. They're trying to get as much money as they can, as any ETF provider is, because they're making a percent. So, you know, that's how they make their money. And Bogle was right. John Bogle, who said, you should aim to own a diverse collection of stocks in an index fund and to do it as low cost as possible, because the returns of all of these companies in the United States or wherever you invest, you get to keep all of those returns and the dividends that come in minus the fees that are collected by financial services companies. And an ETF provider is a financial services company. So Bogle was right about that. Another thing I want to point out here, NVIDIA is kind of a once-in-a-lifetime thing. I mean, this was pretty crazy last week. In case any of you guys missed it, NVIDIA stock went up about 25% in a day last week. And this is because people are all betting against each other. Whenever you buy a stock, somebody else is selling it. Somebody else is making that decision to sell it to you. When you sell a stock, someone else is there to buy it, right? That's how a trade happens. That NVIDIA situation is a once-in-a-lifetime kind of event, at least in my lifetime. I happen to own some NVIDIA stock. I was buying it a few years ago, and I bought it at like 133 bucks a share, and I've been watching the company, and then I bought a bunch more of it because I knew that they were kind of head of the class when it comes to GPUs. But I did not know that that company would jump in price. The stock would go up that much because their earnings and their prediction for future earnings is like way off the chart of expected returns, what people thought they were going to get from NVIDIA. So in my lifetime of buying stocks, this is the first time I've had a stock go up 25% in a day. And what's really rare is it's rare to have that kind of value in front of you where you can see the company and you can see their business and all these other investors see it, but that the price stays what I thought was artificially low, which is why I've been buying more NVIDIA stock. I saw this as a way more than $1 trillion company, and it was selling at a valuation around $700 billion as of like a week ago or 2 weeks ago. It was selling at a market cap of about 700 billion plus. And because of their prediction for increased revenues going forward, people are just immediately recognize like, oh, this company's in a really good position. AI is going to drive a lot of GPU sales. And so, you know, that's a strange situation to have the stock go up that much. And now it's almost $1 trillion company. It's, you know, in the high 900 billion, but I believe that before too long, this company is going to be up at the top level, right up there with the Apples and the Microsofts. So this brings us to the squirrel, and the otter. What's the difference between the two? Well, I think these both relate to investing. You know, the way that has worked for me for a long time is the squirrel approach. You know, the squirrel climbs up and down trees and scurries around on the ground and it collects nuts. And that's kind of like collecting shares of stock or shares of ETFs or whatever. It's kind of building your stockpile of nuts or acorns so that you have a lot later on or whenever you need to sell them to raise money. That's the squirrel approach. I've actually used this approach for many years. That's how I built up my mutual funds in the early days, then my index funds, and now that's how I invest in ETFs. Every month I buy shares of ETFs. Now, the apex approach is what this otter's all about. And in case you guys don't know about the otter, I love this animal because they are apex predators. I saw one of these out on a nature walk earlier this year. I think it was this winter. And you know, it was sitting on a log. It was just eating like a trout that it had pulled out of the water. It had been swimming around in the water, got a trout, carried it onto a log, started to devour it. These things eat birds that fly out of the air. They can eat stuff on land and they can go under the water. They do not have predators. And that's kind of like these companies like NVIDIA, like Amazon, like Microsoft. They are at the top of their food chain. And that's why I like, on occasion, to find stocks that are not the broadly diversified ETFs, but to tactically choose stocks that I think have a chance to not only survive, but to dominate their sectors of the economy, to just, like this guy, like this little otter. They don't have natural born threats in their ecosystem. And you know, there are other chip companies, right? There's AMD, there's Intel, there's Micron, but I don't think these are companies that scare NVIDIA. I think NVIDIA has become the otter, the apex predator. And that's what this guy is, an apex predator, because it's at the top of its food chain and it doesn't have any threats, natural threats in its environment. So that's just something that I think of when I try to invest. For the most part, I am a collector, like the squirrel over there, and I just collect some stocks or some ETFs. I try to get tactical at times. I think you gotta be like an otter, just go for it. This is not financial advice. I'm not telling you guys what to do because I don't know any of your financial situations or your investment goals, but I just want to share with you, this is an approach that's kind of worked with me. And I think that the collecting gradually at intervals over time makes a lot of sense. So Apex versus Squirrel. Have you guys had any stocks that appreciated big time? Have you bought any stocks just either on a whim and you thought, you know what, I want to buy a few shares? Or have you known that this business is going to be a great business and you want to buy its stock and you went ahead and became aggressive and bought a bunch? I don't care how much, you know, it could be a share, it could be 10 shares, it could be 100. But tell me about it in the comment section. I'm really interested to know a little bit about people who view my channel and what kind of investments you've liked and you've tried. So that is that. If you like this video, please give a thumbs up. The squirrel and the otter and I look forward to hearing from you guys in the comment section. And if you're not yet a subscriber, please subscribe to the channel. I have 400 and something subscribers so far. I would like to get up to 500 sometime this summer. And it would be really cool to get to 1,000 subscribers sometime this year. So if you guys have not yet subscribed, I talk about investing, I talk about ETFs, and sometimes I even talk about photography and other creative stuff. I will see you guys in the next video, and most important, make it a great day.